Welcome to the Techno Fundamental Report for February the 1st. What is portfolio turnover? Well, it's simply the buying and the selling of securities within a portfolio. And is turnover a good thing or a bad thing? Well, it depends. It depends on the circumstances. One of the reasons I would recommend turnover is because not every stock is going to work out. In fact, this report here, which is actually a book called The Psychology of Money, it's a very good book, recommended highly. Most public companies are duds. You know, there was a study done of 3,000 stocks, which is the Russell 3000. Of the 3,000, 40% between 1980 and 2014 lost at least 70% of their value and never recovered over this period. Now, the main culprit was competition, so things like the newspapers. So if you were heavily invested in newspapers and you didn't believe in turnover and you just sat there with them, well, you lost your money. And then the index's overall returns came from 7% of the components. So roughly 200 stocks out of 3,000 is what drove the returns for the Russell 3000 on that period. So it is critical not to overtrade, and perhaps it's often best to do nothing and just sit in cash when the market is not acting right. So this would be a time where you're seeing a difficult market, a downtrending market, a bear market, whatever you want to call it. The best thing to do is slow turnover down and build up your cash position, which would mean you get defensive. That said, overtrading is one of the most difficult issues to overcome, even for the most seasoned investors. You know, selling is not fun. It's just not something I want to do. But at some point, if you have rules, such as stop-loss rules, you have to take action. And so overtrading in a bull market, you really want to hold back on overtrading. Now, I want to introduce a new indicator called the SOM rule. Now, this was developed by an economist who did work for the Federal Reserve. Her name is Claudia Somm, and basically what she's trying to determine is, are we in recession? Now, according to this indicator, which by the way has back-tested quite well, you take the last 3 months of the unemployment rate. Now, this economist was a big believer in the unemployment rate as to when to determine a recession. So you take the last 3 months and you average those 3 months. Then you take the lowest reading for the past 12 months and measure the difference. Well, if it gets over 0.5, which right now we're at 0.23, according to this indicator, we would be in recession. Well, we're at 0.23, so currently we are not in recession. Now, we hear a lot of talk about politics. Now, I wanted to mention Bill Clinton because I have a friend of mine who just thinks Bill Clinton was the reason that the market went up so much during his tenure. Well, let's look at the facts. The facts were that demographics came into play here, where the baby boomers started to turn age 35, and we started to go into a growth cycle due to consumption, where the baby boomers were buying houses, building families, buying cars, so forth. The other reason the market went up so dramatically in this period was because the internet was invented. So there was a major invention, a major productivity enhancement. So really, if you think about it, the President of the United States had really nothing to do with the market. The market is all about earnings, all about profitability. And so we know we have an election coming up, and I get asked quite often, how do I feel about it? And I basically say, pay attention to corporate earnings and interest rates. This is kind of a waste of time. Now, I wanted to go back, and I'm taking the new highs on the Dow Jones Industrial Average minus the new lows, just as an indicator of what's going on. Now, this is the year 2000. This is the dot-com bust. And you can see what that particular indicator looked like. Now, this would be the financial crisis back in 08, 09. Again, look at this pattern here of new highs minus new lows. In other words, lots of new lows, not very many new highs, probably none at all, in fact. So this is where we are today, and we're hitting a new high. So this doesn't look anything like this or like this. So looks like a continuation of the bull market. Now, I did want to mention the indexes. We're seeing a pullback in the NASDAQ. You know, the Federal Reserve came out yesterday with interest rates unchanged. We'll talk a little bit more about that. But you can see here that the NASDAQ did take a pretty severe pullback. However, still holding above the moving averages, still in an uptrend. So I think I wanted to mention this particular indicator. You know, we introduce new indicators pretty much all the time. However, I like to go back and, reconvince myself that this indicator is a valid indicator. Well, this one really did do what I needed it to do. This was the power index. And so what we're measuring here is the direction of interest rates in the free market using the 5-year Treasury. We're using interest rates as a way to determine in time as to what's going on. So I noticed back here when interest rates started to come down and the power index went into a downtrend, the Fed quit raising interest rates. So if you get to a reading of below 0, that's telling you that interest rates are in a downtrend. So this is a good situation. So we're getting a very positive reading on the power index. The other thing too here on the S&P and the NASDAQ, and this is the 200-day moving average, uptrend, moving average in an uptrend. So the primary trend continues to be up. Now, another indicator that we introduced was called the Copic curve. Now, the purpose of the Copic curve was to determine if the market had hit a low. It doesn't give you a buy signal. It just simply says this is the low. So we went back through time, and you can see when you get the cross above 0, cross above 0, that usually has meant in the past that the market has made a low. Well, here we are back in 2022 at 3,600 on the S&P. Copic curve turns positive. It really does look like this indicator is worth keeping an eye on, and we certainly will. Volatility index, another indicator, the VIX, down below 15, hovering around 13 to 15. This is positive as well. In other words, as you see, we get down to these levels, good things tend to happen. So the VIX is giving us a positive reading as well. Another indicator, this one has really been a powerful one. This is the aggression index, where we're measuring a ratio of growth stocks compared to consumer staples, mainly the NASDAQ compared to consumer staples. And you can see here, it's in a pretty powerful uptrend. We had sell signals back in 22, which 22 was a disastrous year. In this particular indicator, if you were paying attention to it, and if you do invest in growth stocks, you stayed pretty heavily in cash during this period. Now, another indicator here is the new lows on the New York Stock Exchange. We're below 40, which continues to look constructive. Wanted to mention the banks. The banks are the only negative I'm really seeing right now. The regional banks took somewhat of a hit yesterday. These interest rates are not helping the banks, and actually two banks, which here, this is Columbia Banking System, and this is New York Community Bank. New York Community Bank dropped almost 38% yesterday. We had a big drop here. Now, both of these banks are starting to experience commercial real estate loan problems. Now, is this going to be a continuing theme? We'll have to see, but you can see that the banks are actually having a difficult time. Wanted to mention just one stock that we're finding acting well is a company called Vertiv. They're involved in data centers where they provide the cooling systems, the thermal systems for these data centers. Because one of the big problems with these data centers is they get really hot because these computers are generating so much data, and it's just the way it is. So anyway, you can see here, back here early on, we got, a breakout above the moving averages, been in a very steady uptrend, and the stock just recently made a new high. So it's really all about data centers. So if you have any questions, let me know. Thank you very much.